Module 5, Merchandisers. Gross margin ratio. The gross margin ratio, also known as the gross profit margin, is a financial ratio that measures the profitability of a company's sales after deducting the cost of goods sold, or COGS. The ratio provides insight into how well a company manages its production and sales costs and is often used to evaluate its operating efficiency and pricing strategy. To calculate the gross margin ratio, divide the gross profit by the net sales revenue. The formula is as follows. Gross margin ratio equals net sales revenue minus cost of goods sold divided by net sales revenue, where gross profit equals net sales revenue minus cost of goods sold. A higher gross margin ratio indicates that a company is generating a higher percentage of revenue after accounting for the cost of goods sold. This means the company has better control over its production costs and pricing strategy and generates more profit per unit sold. A lower gross margin ratio indicates that a company cannot control its production costs or has set its prices too low. The gross margin ratio can be used to compare companies in the same industry or to evaluate a company's performance over time. However, it is essential to note that the gross margin ratio does not provide a complete picture of a company's financial health and should be used with other financial ratios and metrics. Additionally, the gross margin ratio can vary significantly by industry, so it is important to consider industry benchmarks when evaluating a company's performance. To calculate the gross margin ratio, we need to use the following formula. Gross margin ratio equals net sales revenue minus cost of goods sold divided by net sales revenue. For example, say we are given that the company's gross profit is $83,750 and its net sales revenue is $347,800. We can calculate the cost of goods sold as follows. Cost of goods sold equals net sales revenue minus gross profit. Or, cost of goods sold equals $347,800 minus $83,750, which equals $264,050. Now, we can calculate the gross margin ratio as follows. Gross margin ratio equals net sales revenue minus cost of goods sold divided by net sales revenue. This gets us to gross margin ratio equals $347,800 minus $264,050 divided by $347,800, which translates to $83,750 divided by $347,800, or 0.241, which is 24.1%. The company's gross margin ratio is 24.1%. This means that for every dollar of sales, the company generates a gross profit of 24.1 cents after deducting the cost of goods sold. Credit terms. Credit terms refer to the conditions under which a seller offers a buyer credit for purchasing goods or services. Credit terms typically include the amount of credit offered, the interest rate or discount, and the period the buyer is expected to pay the seller. Credit terms can vary depending on the nature of the transaction, the creditworthiness of the buyer, and the seller's policies. For example, a seller may offer a 30-day credit term, meaning the buyer has 30 days to pay the seller for the goods or services received. Alternatively, a seller may offer a cash discount for early payment, such as a 2% discount if the buyer pays within 10 days of receiving the invoice. Credit terms are essential for both the buyer and the seller, and credit terms help the seller manage cash flow and reduce non-payment risk. For the buyer, credit terms provide an opportunity to purchase goods or services without paying for them immediately, which can be beneficial for managing cash flow. Both parties must understand and agree to the credit terms before entering a transaction. This can help prevent misunderstandings or disputes over payment terms down the line. For example, the purchase of $1,800 worth of goods with terms 210, net 30, means that the company is eligible for a 2% discount if it pays within 10 days, otherwise, the total amount is due within 30 days. Let's say the company returned $200 worth of merchandise. So, the net amount due is $1,600. If it pays within 10 days, the company is eligible for the 2% discount, so the discount amount is 2% times $1,600, which is $32. Therefore, the cash price comes to $1,568. Sales returns and allowances. Sales returns and allowances is a contra-revenue account in the income statement that records the number of goods or services returned by customers or for which customers have been granted allowances. It represents a reduction in sales revenue and is reported as a separate line item on the income statement. Sales returns and allowances are typical in businesses that sell goods or services to customers on credit. Customers may return the goods or services for various reasons such as defects, dissatisfaction, or wrong shipment. Alternatively, the seller may grant an allowance to the customer for defects, damage, or any other issues. When a return or allowance is granted, the seller reduces the revenue recognized on the sale, decreasing the net income. This reduction is reflected in the sales returns and allowances account. The sales returns and allowances account is essential because it helps management track the number of returns or allowances granted and the reasons behind them. This information can improve the quality of the goods or services offered or adjust pricing, sales policies, or other factors to minimize future returns and allowances. Overall, the sales returns and allowances account is a helpful tool for businesses to manage their revenues and ensure that their financial statements accurately reflect the impact of returns and allowances on their bottom line. The possibility of lost future sales is unrelated to sales returns and allowances. While sales returns and allowances may lead to a reduction in revenue in the short term, they do not necessarily indicate that future sales will be lost. Sales returns and allowances occur when a customer returns goods or receives an allowance due to a defect, damage, or other issues with the goods or services. These returns or allowances may result in a loss of revenue for the current period, but they do not necessarily mean that future sales will be lost. The possibility of lost future sales is typically associated with factors such as changes in customer preferences, competitive pressure, economic conditions, or shifts in market demand. These factors can impact a company's sales volume and future revenues, regardless of the number of returns or allowances granted. In summary, while sales returns and allowances may lead to a short-term reduction in revenue, they do not necessarily indicate that future sales will be lost. Various factors that may impact a company's sales volume and overall financial performance affect the possibility of lost future sales. Expenses. General and administrative expenses are a category of expenses that support a business's overall operations and include expenses relating to accounting, human resource management, and financial management. Therefore, these expenses are not directly related to producing goods or services and are considered indirect. Examples of general and administrative expenses include accounting and bookkeeping expenses, such as salaries of accountants, auditing fees, and accounting software costs. Human resource management expenses, such as salaries of HR personnel, recruitment costs, and employee benefits. Financial management expenses include salaries of finance personnel, legal fees, and insurance costs. Rent, utilities, and maintenance expenses for office space. Communication expenses include telephone and internet bills, postage, and office supplies. Depreciation of office equipment and furniture. General and administrative expenses are essential for the overall operation of a business as they help to keep the organization running smoothly and efficiently. These expenses are typically fixed costs, meaning they do not vary with changes in sales volume or production output. As a result, managing general and administrative expenses is crucial for businesses to maintain profitability and financial stability. In summary, general and administrative expenses are indirect expenses that support a business's overall operations, including expenses related to accounting, human resource management, and financial management. Net sales. Net sales, also known as revenue or sales revenue, refers to the total sales generated by a company during a specific period, typically 1 year. It is calculated by subtracting any returns, discounts, or allowances from gross sales. Net sales are essential for businesses because they indicate the overall performance of the company and its ability to generate revenue. It is a critical metric in financial statements and reports, such as income statements, balance sheets, and cash flow statements. To calculate a company's, we need to subtract the sales returns and allowances and sales discounts from the total sales. For example, say cash sales are $94,275 and credit sales are $83,450. Total sales equals cash sales plus credit sales equals $94,275 plus $83,450 equals $177,725. Net sales equals total sales minus sales returns and allowances minus sales discounts. For example, say $177,725 minus $1,700 in returns and minus $3,475 in allowances equals $172,550. The net sales for this period are $172,550. Internal controls. Internal controls refer to the policies, procedures, and processes implemented by an organization to safeguard its assets, ensure the accuracy and reliability of financial reporting, and promote compliance with laws and regulations. These controls are designed to mitigate risks and prevent errors or fraud in the financial reporting and operations of the organization. There are several types of internal controls, including preventive controls. These are designed to prevent errors or fraud from occurring in the first place. Examples include segregation of duties, physical controls, and access controls. Detective controls. These are designed to detect errors or fraud that have already occurred. Examples include reconciliations, audits, and reviews of financial statements. Corrective controls. These are designed to correct errors or fraud that have been detected. Examples include adjusting entries, disciplinary action, and changes to policies and procedures. Internal controls can be implemented at various organizational levels, including operational, financial, and compliance. They are essential to maintaining the integrity of the financial reporting process and ensuring that the organization operates legally and ethically. Adequate internal controls can prevent financial losses, protect the organization's reputation, and promote the long-term sustainability of the business.